Ladies and gentlemen, you need to be extremely careful investing in the real estate investment trust world, as we just start seeing earnings come out and they are fairly deceptive, as they don't reflect the full impact that the pandemic is having on the market. So in this video, I'm going to break down their earnings and share with you some very serious things you need to ask yourself and pay attention to before making these investments. So ladies and gentlemen, I look so forward to breaking this down for you. So let's hop right into this.
Drop it.
Welcome back, my passive income investors. I like it. I'm going to drop a knowledge bomb as my two favorite REITs just released earnings. Obviously, we're talking about Realty Income and Riocan on the Canadian side of the border. I just got off the conference calls with the CEOs to bring some light, some knowledge and information for the masses. So if you're new to this channel, consider slapping a like and subscribing as we nail these hard-hitting questions like, are these things going to rebound and maybe you should pick them up? Maybe they're a disaster. How many tenants are still sticking around to pay those monthly rents for your dividends? Well, ladies and gentlemen, let's get right into this, starting with Realty Income. If you're in the dividend community, obviously you're a big fan of this company. What we have here is Realty Income's payments that are due from their tenants by May 1st and how we're just starting to see them miss these payments and what specific sectors are getting hit the hardest. So let's just skim through this because it gives us a lot of information about how different parts of the economy are being affected. Starting with aerospace at the top, they've had absolutely no payment deferrals or misses. So what we see on the left side here is basically what represents that sector of their portfolio in the entire percentage, and then how much of those percentages paid as of May 1st, 2020. We have auto collision services missing payments. We've got auto parts that are doing fine still. We got auto services just starting to miss payments. We got automotive tire services majorly missing payments, was really expected with nobody driving. We have beverages somehow doing fine, and by far one of the hardest hit sectors so far, guys, is child care. I guess there's a lot of daycares with schools being shut down. They're having a hard time probably making those payments, so they're asking for deferrals, and we can see that is just got slaughtered on that percentage of the portfolio. Taking a look, guys, we got consumer electronics doing fine, consumer goods. We got convenience stores also just slightly missing. We got crafts and novelties somehow doing fine, just starting to get hit, not as much as I would have expected. We got diversified industrials. Obviously, the industrials are going to be doing fine. Dollar stores doing amazing. Drugstores obviously doing amazing, but apparently some of their tenants still managed to miss those payments. Not sure what that would have been about. Then we have education. So anything aside from those daycares completely wiped off the map. So somehow these sectors are doing just fine when we're talking about electric utilities, entertainment, equipment services, financial services. All of these haven't missed a single payment. Food processing, obviously fine. General merchandise, somehow still doing fine. Government services, great. Grocery stores, obviously. So far, the fair majority doing fairly good, but let's keep scrolling down the list because we ain't done yet, guys. We've got health and fitness taking a major slaughter, considering this made up 7.2% of their U.S. tenants, and it is down almost 5% on those rents collected. We got healthcare doing fine. We got home furnishings getting hit really hard as well. Home improvement still doing fine, surprisingly, but I imagine because most things like Home Depot can still afford to pay their rents. We got machinery, motor vehicle dealerships. We got office supplies here, guys. Other manufacturing, packaging, paper, pet supply service. Most of these doing pretty good up to restaurants and casual dining. As we all know, if you ain't doing Skip the Dishes or Uber Eats, you ain't going to be going to these restaurants, and God knows they're going to have a lot of issues when things reopen up. But continuing down here, guys, we can see that anything related to restaurants, even their quick service, getting hit pretty hard. Shoe stores surprisingly doing fine. Sporting's good, starting to take a little bit of a hit. We got telecommunication doing just great. Theaters have been completely put on hold here. Another super hard hit sector here, guys, where they, again, 6% of that income completely wiped out. So for the month of April going into May, they collected a total of 82.9% of their total rents. Now, what does this say moving forward? Because I don't think we've experienced the hardest hit yet. Considering the CEOs right now are kind of sitting on their hands, being very careful with their liquidity, just analyzing what the next steps are, because we don't really know how long this is going to last. And a good big chunk of what everybody is paying attention to, aside from their earnings, is can these tenants continue to afford to pay rent? And if things continue to be shut down for longer, are things like LA Fitness or these restaurants and theaters going to be completely written off for the entire year on their balance sheet? And that's kind of the at-risk percentage of their portfolio. And I want to kind of just highlight the same thing with Riocan, and then I'm going to kind of touch base on what I think about both of them. Everybody's paying attention to the same thing with Riocan. Nobody cares about the earnings as much as they do about those tenants paying the rent. And with Riocan, we can see they collected about 55% of their total rents for the month of April, with another 28% still to be received, expected to be received, with 17% of them asking for rent deferral. And these two companies on both sides of the borders share very similar circumstance with similar tenants and deferral percentages. I love comparing these real estate investment trusts back to back because they're also my favorite. And now, before I give you my open and honest opinion about what I'm doing with these companies and whether I plan on buying them or not, I want to give you those hard-hitting questions about why you shouldn't buy these stocks, because it's all premised around one real statement, and that is, do you think in the next 6 to 12 months things are going to go back to a somewhat normality where people will be willing to go back into cineplexes and theaters? Will people be going back to restaurants and gyms? And if the answer to that question is yes, then I think these companies are an extremely good value. And I'm going to explain that farther in a second. But if you do not think in the next 6 to 12 months, we're going to go back to a somewhat of a normalized society and people just aren't going to be eating out like they used to or going to gyms, or we're going to start seeing some changes in the way we use office spaces, then these companies might not be the best investment decision for you. And that is just the honest reality. As I said in the beginning, earnings don't really matter here, as we're heading into a very uncertain set of circumstances leading to a lot of volatility in these stock prices for very good reason, guys. We don't know if deferrals keep going up. And the scariest thing as a dividend investor too is these yields look very attractive on both these stocks. But if all of a sudden the AFFO drops to, I think, about 76% on Realty income, and along with Riocan dropping any lower than it has in deferrals, all of a sudden their payout ratio is going to be maxed, and they will be set with questions on whether they cut these dividends, whether they start using debt to pay the dividends in hopes that things come back to somewhat of a normality. And if I can give you my honest opinion past here, guys, and what I plan on doing, I am severely considering still leveraging my line of credit into both of these companies now, not just one of them, but both of them, because the interest rate could easily be covered with the combination of giving a 50-50 split, leveraging in that credit to both of these stocks. And the only thing that I can bet on and take the risk on if I'm using that credit is I think we're going to be heading back to a normal society. I am not one of those naysayers. I'm a glass half full kind of dude, and I honestly just think that at some point in the next 6 to 12 months, most of society is probably going to have normalized. And for where these stocks sits, if I can give you a little bit of comfort, any lightning news for those that you want to actually buy these companies or are continuing to buy them, when you look at the long-term price rate of these stocks, guys, they're trading at crash levels. They have fully priced in the reality that they're facing right now. And if anything, they've overpriced it in, presuming we're not going to see another 10, 15, or even 20% deferral drop on what we've already seen. So presuming everything kind of flatlines for the next couple months and we see what those May and June payments look like coming into that second quarter earnings, because that's where we're going to see the real full impact of this virus on these companies, is on those next quarterly earnings. Because again, guys, these earnings we just had weren't honest earnings. So I honestly think, though, we're going to see things kind of level off here. The people that ask for 60-day deferrals are going to get them. We're going to see the continual impact on the next quarterly statements. And going past that, I think a lot of people want to get out of their homes. I'm getting itchy to get out. I always thought that this was going to shift people's realities into maybe learning how to work out at home and getting used to Uber Eats. But in the same notion, I've come to realize people don't want to sit at home. People want to get out. They want to have experiences. They want to go to the theaters and do things. Even though I'm a frugal bugger and I'm very careful without using coupons approaching those places, I still want to get out and experience things. And I think to an extent, people have over-exaggerated the reality of getting used to the living at home life and nobody ever going to an office anymore. I think those days are going to subside. Now, they are going to leave some substantial impact to what could be a good percentage of these companies' portfolios. But again, guys, I think that has already been priced in. And those good, solid tenants are going to keep paying, affording to pay the dividend where it sits, which right now, Realty Income and Riocan can actually afford to pay. So I'm going to be keeping my eye like a hawk on the stock performance over the next week, coming couple weeks. And if I see the opportunity where I start feeling that itch, that the dividends have come up enough to make sure I feel a lot more comfortable with using the line of credit, I'm probably going to pull the plug, and I think I'm going to separate about $6,000 between both of these stocks. Now, mind you, it is not an easy decision to make. I know I talk about it a lot on this channel, but when you start leveraging the bank's money, guys, you got to be careful. Unlike margin accounts, where you can get what is called a margin call, which means if that stock drops 30%, you either have to top up your account or sell the stock and start paying back the debt. With a line of credit, the only fear and real risk you have in the near term is the fluctuation in the interest rates, because with credit lines, especially in Canada, they have what are called floating interest rates. And as of lately, that interest rate has obviously been floating down, with my interest rate sitting at about 4.9%. It starts making it a lot more attractive to want to use, but you got to be careful either way here, guys, because in the next 3 to 4 months, something really terrible could happen. Who knows? Maybe we get a major second wind of some sort and these companies have to go on full shutdown again. And that's like dead worst case scenario. Then all of a sudden you see interest rates start to re-hike up, and all of a sudden banks aren't handing out as much money, and then I'm forced taking a loss on this and, you know, paying back the debt so I'm not stuck making the interest payments. I mean, those are realities you have to consider. But for the risk versus reward, if I were to use this line of credit and hold on to these companies for over a year, guys, I honestly think that if things come back to a somewhat normality over the next few months, I could see both these stocks doing an easy 20% spike from where they currently sit today. And that is my kind of mood and feeling around these REITs. And I'd love to know what you think about these recent earnings in that comment section below, guys. I'm really loving these prices, and I'm really loving the entertainment that these conference calls are earning. I know we're living in really terrible times, but historically, being the first crash I've ever experienced as a professional investor, I have to say it's some of the most fascinating stuff, and it causes me to pay an hyper amount of attention, which I absolutely love. So if you guys enjoyed this, again, consider slapping that like. Let me know what you think in that comment section below. But stay cool, stay awesome, and I look forward to talking to you tomorrow.